Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for WealthPress. And today is Monday. It's July 25th. It is finally, now I'll say it correctly, the last week of July. This is going to be a very fragmented week for me. I'm traveling to New York tomorrow morning, but I will do my videos every day this week to make sure you guys have what you need. And I'll be in the VIP program 3 days this week. So I'm going to be there for you. Now, it's about 7:57. The market's going to open up in about an hour and 33 minutes to be very, very specific with you. The Dow's up about 150. The NASDAQ is up 73, which is quite a bit. And the S&P is meeting us halfway in between. Now, this is going to be a very, very important week for the market. First of all, we've got a lot of data. You've got consumer confidence. You've got new home sales. This consumer confidence report tomorrow is going to be very, very timely. And I like to see consumer confidence reports before GDP, not after GDP, like consumer sentiment. I mean, this drives me crazy. Consumer confidence, they put before the GDP. Consumer sentiment, they put after the GDP. Do you really think the consumer sentiment is going to have a lot of value after the GDP report is out? I mean, it's just, it's ridiculous. But here we are. So the big news is going to be obviously consumer confidence, new home sales. It'll be very interesting to see if they're upticking again in light of the T-bonds stalling their incline. You've got durable goods orders on Wednesday, international trades in goods and services. You've got the FOMC announcement, which will be very interesting, and then you have the GDP. Again, it would be kind of nice to have the GDP before the FOMC, but the truth is, I'm not the Fed. The GDP is going to be the most, obviously, the GDP is the biggest report of the quarter. It'll tell us if we're contracting or growing. If the report is slumping again, then we are 2 quarters in a negative environment, which is technically a recession, but a lot of economists disagree with that, including myself. I think with the worst may be behind us, and this information is a little bit lagging behind. Now, we're looking at a growth of 0.5, but look at the range, negative 1.1 to positive 1.5. It's all over the place. I'm actually more concerned with expenditures. I want to see expenditures not decline too much. If expenditures don't decline too much, then it can be really, really positive. But as you could see, we're all over the place, and we're looking at 0.5. A lot further from 2% that we wanted to have. But nonetheless, here we are. That's the GDP number. That's what's priced into the market. So there's going to be a lot of market moving material, a lot of market moving data this week. Now, speaking of market moving data, last Friday, matter of fact, if you looked at the bond market, you would have seen that the bond market went to the upper end of the range. And I've been waiting for that to happen for quite some time. It hasn't happened since we were right here, but I went ahead and sold it, and we are now down at the 117 level, quite a bit lower, about $1.60, about a 1.35%, excuse me, lower. And I think the bond market is going to start its descent. I believe the bond market is going to remain in this choppy, range-bound period for the foreseeable future, at least till we have a little more certainty if we're going to be in a recessionary environment, if we already were and are in a recessionary environment and the worst is behind us, or the recessionary environment is just too darn away from us to really care right now, which could be the fact too. But the bottom line is the earnings so far, and I'll give you an update on that later today, earnings so far have been better than expected. Now, it's a little too early and premature to have a party over it, but the numbers have been better than expected. Now, speaking of earnings, you should get a piece of paper and a pen for this. So today, you've got some banks. I've only put on the big ones like NXPI, 335. These are their EPS expectations. You've got nothing really huge that stands out. Whirlpool, Southern Copper, Rainier Holdings, but nothing. Newmont Mining, this will be an interesting one to see, especially future-looking statements. Nothing really crazy, right? Nothing really crazy today that jumps off. But look at tomorrow. Oh boy, you've got Google. You may want to write this down because this is the numbers that's baked into the stock right now. They're expecting revenue to go up 13% to $70 billion. And they're looking their earnings to decline to $1.30. So upside on revenue, downside on earnings. Not a lot of upside on revenue, but 13%, not a lot of downside on EPS, but a little revision. So $1.30 is what they're expecting, and $70 billion. Then you've got another little baby stock. I'm just messing around. One of the biggest stocks in the world, one of my favorite stocks. They're going to be reporting, this is the expectation, $2.30 per share, which is a 6% increase on 13% higher revenue, which is $52 billion. I can't believe that Google is going to be reporting more than revenue than Microsoft, but here we are. It's a whole different world. So again, you may want to write these numbers down, or you may want to take a screenshot of this, because this is what's baked into the market. Aside from that, we've got a couple of other big stocks like 3M coming out on Friday at $245 they're expecting. Chipotle, interesting stock. Coca-Cola, Chubb, Corning. These are really big stocks. You've got General Electric and General Motors, Juniper Networks, very important communication stock. Kimberly-Clark, McDonald's, P-Car, not that big anymore. Pulte, this will be interesting. I know one of our publishers loves Pulte Group. Wink, wink. Shutterstock is coming out. That's always an interesting. Shoe stock. This will be interesting impact on Nike. Airline, another airline. Teradyne. As you can see here, we've got a lot of good stuff happening tomorrow. UPS, Troop, TransUnion, UBS. Name it, it's coming out. And then on top of that, you got Google and Microsoft. On Wednesday, oh boy, you've got Meta reporting, and they're looking for a 38% revenue dump per share. This may be a little overdone, 38% EPS, and they're looking for revenue growth. So I think this EPS may be a little bit overdone. Analyst estimates are $2.61 per share. I think I just wrote this twice. I don't know why. I'll just delete that. So $2.61 per share on $29 billion year over year revenue. And again, there's a lot of other stocks coming out like Boeing, like Amedisys, like Align, like AM, Boot Barn, Robinson, Cake. I mean, a lot of stocks. You got General Dynamics, Genuine Auto Parts, Hilton's coming out, Kraft, O'Reilly, Qualcomm, Service, Sherwin. And again, these are all the EPS. Spotify, that'll be interesting one. My daughter loves that stock. T-Mobile, T-Doc, United Rentals. I mean, everywhere I look. And then Thursday, there's nothing really crazy on Friday, but I'll get into that later in the week. But on Thursday, you've got Apple, $1.16. They're looking for a decline. I think this is the first year-over-year decline in a long time. EPS, 10%. It'll be interesting to see if they can overcome this. And a revenue of $82 billion, slightly a hair above last quarter, a year-over-year, excuse me. And then you've got Amazon. They're looking at a revenue of $119 billion, up 3.4%. And they're looking at EPS of 15 cents per share. And I think revenue, I think they're going to beat this EPS number. So I think the worst is already priced in for a lot of these companies. You may want to take a screenshot of this, but this is the expectation. So we're starting out slow, but tomorrow, Google and Microsoft, and I'll keep updating you as the week goes on. And as I said, we've got the Fed announcement on Wednesday, and you've got GDP on Thursday. This is going to be a very, very busy week. As far as cumulative strength index, energy, utilities, healthcare, consumer staples, you've got defensive stocks controlling on a cumulative basis, but on a monthly basis, you've got consumer discretionary and technology. If we look at it visually, I think that consumer discretionary, notice we've reached that resistance, that prior level, the pre-8.6 CPI level, and it looks like we're going to bounce off of these levels. It looks like we're going to bounce down. Technology looks like we're going to bounce down. Healthcare can go either way. It looks like we're just going to stay kind of choppy with it. Real estate's looking a little good. Looks like it's got a little more upside to go. But technology and consumer discretionary don't look good right now. Consumer staples looks like it's got a little more upside. Financial looks like it's going to go down with tech and consumer discretionary. Industrial looks like it's going to go down. Energy looks like it's going to go down for another count. Basic materials looks weak, and communication services looks like it's almost there. So I think we're going to see downside next couple of days from consumer discretionary and technology. It'll be very interesting to see if they can rebut my presumption. But it looks like they're a little overdone, and it looks like these stocks are ready to go down. With that said, I think healthcare, I think real estate, consumer staples, and utilities have a chance at rallying. And maybe energy will start coming back up a little bit because it looks like it can consolidate and come back up. So look for defensive stocks to start rallying, and look for speculative stocks to start coming down a little bit. And that's also what the bond market's telling us, with the yield getting a little bit higher on the yield. So as the bond market goes down, remember, treasury yield goes higher. So interest rates get higher, which is more pressure on speculative stocks. So look for a little bit of a reversal, but keep your eye on the GDP and the Fed data and how the bond market reacts to all of that. Now, folks, I just recorded a training on what quickly became my favorite strategy. It covers exact details of this strategy, plus why trading strategies that worked for the last 2-3 years are getting wrecked right now, how traders are using the candlestick patterns all wrong. You really need to see this, and I've got quantifiable data to prove it to you. A little known secret on how to tap into dirt cheap call options when these patterns show up. Excuse me. How candlestick patterns have the potential to be used to identify short-term price reversals before an explosive moves occur. And free, that's right, free, no cost, step-by-step instructions on how to trade these 5 candlestick patterns on the S&P 500 and other stocks. Follow the link below. Don't wait. Don't procrastinate. You're going to miss out if you do. You definitely want to pay attention to this. In terms of global economy, we're waiting for the Federal Reserve to raise key interest rates and for update on inflation, and oil fell nearly $1 a barrel. They're more than likely going to announce 0.75 rate hike. Again, keep your eye on the reports, and folks, you want to watch this video. Pattern Trader is really hot. You got to learn about candlesticks. Follow the link below. You got to check this out right now. You really do, before we pull it offline. I'll talk to you guys later. Have a great week. Send me love letters. Comment below this video. Support@marketgeeks.com. Bye, guys. I'll talk to you soon. Hopefully, I'm keeping you out of trouble right now.